The wire confirmation shows $6,200,000,000 at 11:18 p.m. Manhattan time. 2 signatures. 1 sovereign fund. 1 bridge facility. 4 jurisdictions. The debt package clears. An airline survives the quarter because of a conversation you finish in 9 minutes. Nobody in the room claps. Nobody says your name. You close the folder, slide it to legal, and ask for the exposure report on the next mandate. 3 floors below, someone is still dialing strangers from a printed sheet. You start there. You are 22, sitting in a room with 41 other junior brokers on a floor that smells like burnt coffee and copier heat. Your base salary is $32,000. The real money is commission. You have a folding chair, a landline, and a list of 200 names pulled from somewhere nobody explains. The script is 3 paragraphs long. Small cap growth story, limited allocation, position building ahead of institutional interest. Most calls die before your second sentence. Some die before your first. One man tells you he buried his wife last week and asks why people like you keep calling during dinner. You pause, cross out nothing, and dial the next number. By week 4, you stop reading the script. By week 6, you stop hearing the insults. By month 3, your close rate puts you in the glass room at the back with the other top producers. That room changes the temperature of the job. Now the junior dialers warm the leads. By the time a call reaches your desk, the prospect already wants to believe. Your job is to attach urgency to that belief and turn it into a wire. Your first real close is $48,000 into a microcap biotech with 1 patent application, no approved product, and a paid promotion agreement your firm never mentions on recorded lines. The trade prints. Your commission clears that night. A retired dentist asks whether you are buying the stock personally. Your cursor hovers over the order ticket. You redirect to the House Research view and ask how many shares he wants. At Christmas, a client sends a bottle of scotch to the office. You leave it unopened in your drawer for 3 months, then give it to a manager on his birthday without the card. You stop correcting people when they call you an advisor. The brutal thing you learn here, the product is not the stock. The product is the client's trust. You are 25. Your book is 63 clients deep with roughly $14 million in combined assets under influence, not discretion. There is a legal difference. There is a practical difference. You use the second one. Your total compensation last year is $410,000. You move into a 1-bedroom you are never in. You buy suits that fit before coffee. Now you are selling private placements, pipe allocations, secondary offerings, and thinly traded names that need volume. You know which issuers have investor relations firms seeding narratives. You know which independent research notes are functionally marketing material. You know because the sequence repeats. First, the position gets built quietly. Then the story appears. Then retail volume arrives. Then someone exits. A surgeon in Connecticut keeps $780,000 with you because you answer on the first ring. He asks if the lockup on a placement matters. You see the restriction period in the placement memo. You read the paragraph twice. Then you summarize the upside and move to allocation size. You say nothing about the fee split between the issuer and your firm. You say nothing about who already owns the paper. You finalize the subscription docs and send them for signature. The junior broker beside you is from Ohio, 23, still eager enough to believe enthusiasm changes the quality of what is being sold. You rewrite his script. Shorter opener, more silence, fewer facts, better close. He asks one afternoon where the lead list comes from. You hand him the revised version and tell him to work the first 50 names before lunch. You always take the meeting. That becomes your rule after a managing director from another floor invites you upstairs for drinks you cannot afford to refuse. You learn more in 90 minutes than in the previous year. Which issuers are inventory problems? which family offices are parking stock for a fee, which sales desks get protected when regulators ask the wrong questions. A client's account statement shows losses across 3 names you recommended. He calls angry. You rotate him into 2 new positions generating fresh commission and frame it as tax-aware repositioning ahead of a catalyst window. He thanks you for staying proactive. You send the confirm. You don't reopen the old statement. The brutal thing you learn here? Performance matters less than continuity. As long as the relationship survives, the revenue survives. You are 29, running a pod of 12 brokers on a floor that clears just under $2.7 million a month in gross production. Your payout is tied to their output now. The unit of measurement changes. Not accounts, not households. Throughput. You stand at the front of the room every morning at 8 a.m. and brief the desk on priority instruments. 1 reverse merger story, 1 energy exploration name, 1 structured note tied to a basket nobody on the floor could explain from first principles. It does not matter. The pitch does. The younger brokers watch your face when you talk. You give them certainty. That is your most transferable skill. The first time legal calls you into a closed conference room, there are 2 outside attorneys and a compliance officer who has never been on the sales floor. The language changes immediately. Not truth, not honesty. Exposure, record, process, defensibility. You are asked to review recorded scripts and email chains. You start removing specifics that create liability. Target prices, time frames, implied guarantees. Language that turns a sales conversation into a representation. You build a new talk track that says less and protects more. One broker wants to mention that the firm has already accumulated inventory in the name being pushed. You delete the line from his draft and tell him to keep the conversation principle-based. Later that quarter, the SEC sends an inquiry letter regarding promotional coordination around one issuer. You oversee the document collection. It is technically complete. It is operationally narrow. The folders that would widen the timeline remain closed because nobody requests them specifically. You label the omission scope control. You do not expand the inquiry. Your floor posts a record month. You get a new office with a door. A physician with $1.3 million in account equity asks to move half his balance into cash. You can see the sales contest leaderboard from your desk. The quarter closes in 6 days. You walk him through opportunity cost, market timing, tax inefficiency, and the risk of missing a reversal. He leaves $900,000 in place. You hit the number. The brutal thing you learn here? Compliance is not about honesty. It is about building a version of events that can survive contact with review. At 33, you leave retail-facing sales entirely and move into structured products and capital formation at a lower-profile shop with cleaner stationery and dirtier mechanics. Your compensation is $1.1 million. Your title is Managing Director, Capital Solutions. The title matters because now institutions answer. You are no longer moving households into stories. You are placing convertible debt, pre-IPO secondaries, SPV allocations, and cross-border capital into vehicles designed to sit upstream from the noise. The structures have names now: Cayman Islands Exempted Company, Delaware Feeder, Luxembourg SOPA RFI, British Virgin Islands nominee layer for concentrated accumulation ahead of public interest. You learn the architecture. That is the real promotion. A founder wants $140 million in growth capital without pricing a down round. You build a tranche stack. Senior secured note, detachable warrants, ratchet protection, information rights strong enough to control the next financing without formally controlling the company. The docs are airtight. The optics are not your department. An associate flags a side letter that gives one anchor investor better downside protection than the rest of the syndicate. You read it. You close the tab. You tell him distribution does not require identical economics, only disclosed economics where required by subscription class. You don't forward the side letter wider than necessary. Twice a year you fly to Zurich to review entities that never appear in public-facing summaries the way they operate in reality. One vehicle accumulates quietly before research coverage lands. Another is used for block exposure where beneficial ownership timing matters. A third exists to warehouse positions until the visible fund can enter cleanly. You stop saying offshore. You start saying jurisdictional efficiency. At a dinner in Mayfair, a sovereign wealth representative asks how early your capital enters before retail volume notices. You answer in ranges, not dates. He smiles because precision is vulgar in rooms like this. You stop writing things down after meetings. Not because anyone tells you, because you no longer need to. The brutal thing you learn here: the market rewards discovery publicly and coordination privately. You are 37, partner level, overseeing roughly $850 million across 4 vehicles and multiple synthetic exposures layered through swaps and total return structures. The folder goes to legal before anyone finishes reading it. You do not chase flow anymore. Flow arrives shaped around your preferences. Your base is $350,000. Your carry last year is $9.4 million. The number matters less than what it proves. You are inside the architecture now. You sit on investment committee with 6 people. Every deck is pre-read. Every recommendation is already leaning one direction before the meeting starts. What changes outcomes is not argument, it is framing. A listed logistics company in Southeast Asia becomes a target for gradual accumulation. The visible registered fund cannot move first without disclosure pressure. So a Cayman SPV starts building through counterparties over 11 weeks. A BVI entity warehouses additional exposure. When local retail forums pick up the undervalued infrastructure angle and volume rises, the visible fund appears as if arriving on confirmation, not initiation. That sequence is not illegal by default. That sequence is not innocent by design. Research sends you a 46-page memo on supplier payment irregularities at the target's largest subsidiary. Expanding the workstream would delay deployment and might force valuation revision. You mark the issue non-core diligence pending post-close integration review. You do not expand the inquiry. The deal goes through. The stock re-rates. The exit window opens exactly where the model said enthusiasm would peak. A portfolio manager on your team wants to know whether the family office account should receive the same liquidity access as the flagship fund during unwind. You answer with mandate hierarchy and redemption profile language. What you mean is simpler. Priority follows importance. Importance follows capital. You spend 160 nights away from home that year. Singapore, Geneva, Abu Dhabi, London. You forget what your kitchen sounds like in the morning. A founder you financed 3 years ago asks over dinner whether you ever think about the people on the other side of the cap table. You cut his steak in half with the side of the fork, ask about his next acquisition, and move the conversation. You stop needing to justify the choice before making it. The brutal thing you learn here? Capital does not want fairness. Capital wants sequence. At 42, you are no longer just allocating money. You are shaping what can be investigated, financed, delayed, or ignored. You oversee direct and influenced exposure north of $2.4 billion. You sit on 2 advisory boards and fund 1 policy institute through a chain of donors and entities clean enough to survive scrutiny and opaque enough to discourage it. Your phone contains 3 numbers saved without surnames. One belongs to a senior treasury official who understands cross-border flows better than most ministers. One belongs to a regulator inside a market surveillance division focused on short activity and settlement stress. One belongs to a former deputy central bank governor who now chairs a private advisory council your office quietly bankrolls. None of these people work for you. That is why they are useful. A competitor's fund is over-levered in a utilities trade, financed through margin-sensitive prime brokerage lines. You learn the concentration before the market does. Not from a leak. From the shape of collateral calls, the widening borrow, the nervous timing of side conversations that stop when you enter. Your team drafts a market note that, if circulated broadly, would force more people to look closely at the same fragility. You review it and classify dissemination as counterproductive signal contamination. You suppress the wider distribution. 3 days later, pressure arrives from somewhere else, at the right broker, in the right size. The competitor de-risks at terrible levels. Your side is positioned before the disorder becomes visible. A parliamentary committee in one jurisdiction begins asking questions about foreign participation in strategic infrastructure assets. You are invited, unofficially, to a policy dinner. No notes, no staff. The wine is older than the committee chair. The language is all about stability, domestic resilience, and patient partnership. The bill softens in committee. Your asset retains its economics. A chief risk officer on your team asks whether an internal review should map political contribution pathways around one pending mandate. Your pen rests on the paper for a second. Then you mark the review as outside operational need. You don't reopen it. You have become very precise about what not to know in documented form. The brutal thing you learn here: the system does not require lies. It requires disciplined limits on how far anyone is willing to look. It is 2:13 a.m. in London, on the 17th floor of a hotel you only know by elevator carpet and room number. The city is black glass outside the window. 2 options sit on your screen. Option A: support an emergency refinancing that preserves payroll through year-end for 18,400 employees across 3 countries, but forces a covenant breach upstream and triggers losses across a sovereign partner vehicle plus contagion through 2 warehouse lines. Option B: let the restructuring proceed under the pre-negotiated framework, ring-fence the creditors, protect the funding channels, and accept that roughly 6,700 jobs disappear within 90 days. You run the numbers because you always run the numbers. Refinancing need: $740 million. Available bridge at current terms: $410 million. Gap after sponsor contribution: $190 million. Estimated secondary losses if the system absorbs the shock now instead: manageable, but only if labor takes the first hit. You check the waterfall once. You adjust nothing. Legal has already drafted both pathways. Human Resources calls it workforce rationalization in one deck and continuity preservation scenario in the other. On your screen, they are just tabs. You click the creditor protective structure. The execution memo routes automatically to Council, Treasury, and the steering group. A calendar reminder for 2:30 a.m. appears. Asia liquidity briefing. You join it on time. No sentence forms around what the 6,700 means. No sentence needs to. The brutal thing you learn here: when the system is under stress, people become variables and institutions become priorities. You are 51. No public title fits what you do now, so people use placeholders: Chairman Emeritus, Senior Advisor, Principal, Trustee. The truth is simpler and less legible. You decide. Other people explain. The capital you directly manage or structurally influence is above $11 billion, with leverage channels extending far beyond that through consortium finance, reinsurance wraps, sovereign co-investment, and private credit backstops that will never carry your name in a headline. You have not executed a trade ticket yourself in years. You do not need a terminal in front of you. You need timing, trust, and the willingness of others to act on a sentence phrased carefully enough. You sit in rooms with no windows and private dining rooms with bad art and perfect service. Agreements finish before dessert. Some become term sheets. Some become policy shifts. Some never become paper at all. The cold calling floor exists in another building now, run by younger men who think aggression is the asset. You know better. The asset is selectivity. The asset is silence. The asset is deciding which facts are allowed to meet each other. A junior executive sends you a draft biography for a conference introduction. It lists boards, funds, restructurings, market interventions you were instrumental in. You remove half of it. You leave only enough to make doors open. You no longer explain yourself even in private because there is nothing left to explain that would change what comes next. At 8:07 a.m., a new associate is brought into a conference room carrying coffee in both hands so he can open no doors for himself. He is 24, sharp suit, nervous posture, the exact age when ambition still looks clean from the outside. He sets the tray down too quickly and a little coffee slips into the saucer. He apologizes to no one in particular. He thinks the job begins when someone notices him. You watch him straighten the legal pad, cap his pen, and wait for permission to speak. Nobody gives it. Then the managing director across from you slides him a folder and says there is a client in Singapore who needs a call placed before lunch, and the young man nods too fast, like speed itself can make him ready for the room. He picks up the folder with both hands. He thanks everyone separately. He still believes the hard part is getting in.